Welcome to Wealthion. I'm Wealthion founder Adam Taggart here with a short explainer video on an important topic you likely haven't heard much about yet. But it may hold the key as to whether the economy thrives or fails from here, so it's worth you knowing a bit about it. Right now, the world's focus is on how hot inflation is running right now, and that's completely understandable. But in terms of where we should be placing our concern, we may be getting distracted from the true threat, which, hard as it may be to believe right now, is much more on the deflationary side of things. If you've watched the recent videos on this channel, you've heard many of our recent expert interview guests paint the picture of the many storm clouds gathering on the macroeconomic horizon. But there's a concept you haven't heard them mention yet. It's called debt saturation. I was first introduced to this concept over a decade ago by my good friend Charles Hughes Smith, who runs the excellent website of2minds.com. Debt saturation was a significant factor in triggering the 2008 global financial crisis, and now, once again, it looks poised to potentially pull today's economy into recession within the year ahead. To explain its importance, let me provide a little context here. Consumer spending makes up 68% of total annual economic activity. If it falters, the economy falters. And much of our consumer spending is funded by debt. That's mortgages, auto and student loans, credit card debt, etc. Looking at the growth in total consumer credit since the 1950s, you can plainly see how Americans are taking on accelerating trillions of dollars worth of debt to fund their lifestyles. So the connection to make here is that the way things work today, if consumer borrowing slows, economic growth slows. Okay, now to the concept of debt saturation. Saturation, as all junior high science lab students can tell you, determines a system's limit to absorb something. Anyone who's spooned enough sugar into their lemonade or iced tea knows there's a point at which the sugar stops dissolving and starts piling up at the bottom of your glass. At this point, we say the drink has passed its saturation limit. It can't absorb any more sugar. It's important to note that saturation is an event. It's a sudden change in trend. Sugar dissolves just fine when being added spoonful after spoonful until bang, the saturation point is hit and then none of the sugar added after that is absorbed. It's kind of an all or nothing situation. Saturation works in similar fashion with consumer credit. Consumers will borrow and borrow to fund their lifestyle until bang, they hit the point where they simply can't borrow anymore. Either because they can't get access to affordable credit, which is what happened during the 2008 credit crisis, or because they've simply hit their debt saturation point, the point at which they can't take on any more debt because doing so would make it impossible for them to service their existing debt burden. At this point, they're staring at insolvency. They've hit the maximum debt load they can handle. And for a system dependent upon consumer spending funded by debt, this is a big problem. No matter how many new line of credit offers or credit card deals or payday loans get extended, the consumers suddenly stop absorbing them. They pile up untouched, just like the sugar at the bottom of a lemonade glass. And as the borrowing slows, spending slows, and the economy slows. Now that then risks becoming a vicious cycle. As consumer demand slows, asset prices come down. Falling asset prices restricts consumer spending further because households feel less wealthy, and that then slows the economy further. And if it gets to the point where it starts shrinking, which we call recession, then companies start laying off workers who then lose the income with which they need to pay back their debts. These people may start selling assets to raise funds, which puts further downward pressure on asset prices. Or they may start defaulting on their debts, which starts causing the lenders to struggle and forces them to either lend less or lend at higher rates, which of course further constrains economic activity. So this is why the concept of debt saturation is so important. As well as is the question, how close to the U.S. consumer's debt saturation limit are we right now? And while no one knows that answer with exactitude, we can clearly see from current macroeconomic trends that we are accelerating towards it. For starters, inflation's running at a 40-year high. The official consumer price index now stands at 8.5%, though anyone viewing this video has likely seen price increases of closer to 20% over the past year in key essentials like food, fuel, and housing. And wages aren't keeping up. Real hourly wages have now fallen for each of the past 12 months straight. And the more than $10 trillion worth of extraordinary stimulus issued in the wake of the pandemic has now been turned off. Both the Federal Reserve's hundreds of billions of dollars worth of monthly quantitative easing, as well as the fiscal stimulus programs like the stimmy checks, the extended extraordinary unemployment benefits, the increased child care payments, the eviction and foreclosure moratoria, all of those are over. And soon, student loans will go back into repayment as well. So, given fallen real wages, the sharp increases in the cost of living, these combined with the cessation of so much government support, it's a little surprised that we see the consumer is starting to struggle. The personal savings rate has fallen below its pre-pandemic level, close to a 10-year low. Kathy Bostanagic, chief U.S. economist at Oxford Economics, reports that at this point, the lowest quintile households have largely exhausted their savings. As their savings deplete, Americans are loading up on debt to keep their lifestyles going like never before. In Q4 last year, credit card debt increased by the greatest amount in history. And the demand has continued into 2022, with February, the latest month for which we have data, seeing the highest monthly change in consumer credit in the past decade. And by the way, this turn to debt isn't just a U.S. phenomenon. We're seeing the same in a number of other countries. This chart shows that credit card debt borrowing in the UK just hit a record high as well. All right, back to America. So with all the recent borrowing, credit card debt has jumped to a new all-time high of $930 billion. And right as we hit these all-time high levels of consumer debt, the cost of debt is fast becoming more expensive. For example, the cost of getting a mortgage in the U.S. has risen tremendously over the past year. The average national rate for a 30-year fixed mortgage was just 2.77% back in August. It's now at 5%. That's nearly a doubling. And with mortgages becoming so much more expensive so quickly, and we'd expect to see a cooling off in the red-hot U.S. housing market sometime soon. In fact, we may already be seeing some of the early signs of that. Home listings firm Redfin just reported over the weekend that 12% of homes on its site saw sellers cut prices in the week ending April 9th. That was the biggest one-month spike Redfin saw in price cuts since 2015. With the cost of debt rising, consumers are also balking at refinancing their homes. Mortgage refinancings have plummeted 60% compared to just a year ago. Mortgage refis and home equity loans have been a source of cheap debt for millions of households over the past decade, who borrowed confident that their home's continued price appreciation would pretty much pay for the loan. With lending prices now prohibitively high and the fear that home prices may start rising or, gasp, even fall, the party in refis and HELOCs may be over. Now, with their depleted savings, higher costs, and worse options for borrowing, we're starting to see the consumer is reducing their discretionary spending. As the chart here shows, consumer spending in March was mostly driven by fuel costs. Spending on merchandise, clothing, and eating out has been in decline since the holidays. In fact, a recent report by Lending Club reveals that 64% of Americans now say they're trapped living paycheck to paycheck. Even among those earning six figures, 48% said they're now living paycheck to paycheck as well. And thank goodness the U.S. job market remains robust, with millions more openings right now than workers. But what if that isn't the case going forward? Inflation and the rising cost of capital are biting into profit margins. And as I've said multiple times already, slowing consumer spending slows the economy. If we enter recession this year, which the recently inverted yield curve is one of our most dependable predictors of, those excess jobs could very well disappear, replaced by layoffs. Should that indeed happen, today's strapped consumer can easily become tomorrow's debt defaulter. So in closing, while we don't yet know the exact point at which the U.S. consumer will hit their debt saturation limit, from the preponderance of evidence here, we can clearly see how we're accelerating towards that breaking point. And I'm not guaranteeing we'll see such a collapse of the consumer, but I am saying it's a risk worth paying attention to, especially if the current trajectory continues. Now, in terms of what to prepare for, the list includes recession, a serious price correction in financial assets like stocks, bonds, and real estate, job layoffs. Think back to the 2008 crisis and the dot-com bust. Ask yourself, how well am I positioned to weather a year or more of those kinds of conditions? How secure is your income? Are your personal debt levels under control? Do you have enough emergency savings to see you through? Is your financial portfolio prudently positioned? Are the other people in your life who you care about taking similar steps as you? As always, we at Wealthion recommend enlisting the guidance of an experienced professional financial advisor who can help you design and execute a plan for persevering, perhaps even prospering, should more troubling times indeed lie ahead. If you want to set up a free portfolio review with the advisors that we endorse, just go to wealthion.com. And whatever happens from this point, be it stagflation, recession, or some completely surprising curveball, we'll be tracking the macro situation here every week at Wealthion, continuing to give you access to the world's top experts in money in the markets so that we can leverage their expertise to understand what's most likely to happen next and how we can best position in advance to protect and prudently grow our wealth. Now, if you enjoy short explainer videos like this, folks, and would like to see more of them, please support this channel by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. And if there's any kind of topic you'd particularly like me to address in an upcoming explainer video, just let me know in the comments section below. Thanks so much for doing that, and thanks for watching.